Welcome back to the Alpha Uncovered podcast. My name is Alvin Fan. I'm the CEO of OP Investment Management, Asia's #1 hedge fund platform. I have a really special guest today, a good friend of ours, Jonathan Ting, who is currently in the middle of launching his first fund, which is a private secondaries fund, which I'll get Jonathan to explain in a second. But Jonathan was previously at Industry Ventures, and prior to that, he was at Mirador Capital and actually started his career still also in the Bay Area. Did you start in Bay Area or did you start in Shanghai, actually?
Yeah, I actually started out of college in Shanghai, and I was working for a software outsourcing firm there. But then when I moved back to the States, that's when I got into finance. I decided I wanted to get into the investing side of technology instead of the building side of things. So that's when I did my investment banking route, joined Mirador, which was a RIA on the public side, and then Tri-Valley Ventures, which was an early stage venture firm on the polar opposite ends. And then finally, I found my way to Industry Ventures, which is, venture secondaries firm right down the middle.
I want to get into the definitions because the private sector has kind of expanded so much since I started in this space, which was a very healthy 20 some odd years ago. And the dynamics are so segmented now that I think it's worth revisiting. So maybe let's just take a step back, and from our perspective here, and most of the managers we have on the show are usually from the hedge fund space. So we look at alpha, we look at secondary markets, publics, etc. But a lot of our investors are very much invested more heavily actually in the privates. And this is because of the first and second generation family office environment. The institutions are very much involved, and it's very fundamentally driven, of course. So from your perspective, maybe you can just give us first a 20,000 foot view of where we're at in the cycle right now. And we touched on it in the intro where we're in a kind of a weird tariff space, but at the same time, there's a ton of money coming into the space. I was looking at PitchBook, I think the number was something like $1.6 trillion still in dry powder, ready to deploy in this space. So even though everyone's worried about real market dynamics, we're still coming out of COVID where private equity kind of stalled for quite some time, and a lot of IPOs had gotten pushed back. So why don't you walk us through where we are today, and then we'll go from there.
Yeah, happy to. That's a big question to answer. But I think where the markets sit today in terms of the private landscape really has to do with what's happened over the last decade or two of low interest rate environments in the US. With low interest rates, treasury bonds yielding 2-3%, public equities yielding really low and prices getting high, that really drove a lot of institutional investors and thus retail investors out onto the risk curve, right? You're going into private equity, you're going into venture, you're going into distressed debt investing. And that low interest rate environment created this kind of environment where nothing can really fail because the capital is going to always be there. And that turned into, in the venture side, was capital allocations being 3-4x what they were in, let's say, 2012, right? So if you look at venture capital allocations, which is LP money flowing into the venture capital asset class, in 2011 and 2012, it's pretty stable. Once you get to 2013, 2014, that's when you see 3-4-5x increases in the amount of capital coming in from institutionals, from sovereign wealth funds, university endowments, you name it. And they're going out on that risk curve. And one is that's pushing it. Two is the low interest rate environment allows for valuations to move up. So while these companies are growing and in an environment where you don't really need to worry about the downside, all you're chasing is growth, well, you can start pushing those valuations up pretty high, right? So we saw valuations during that period go from normal 5-6 times revenue kind of figures to 20, 30, 50 times revenue. I think at the peak of COVID, Snowflake was trading at 60 to 70 times forward revenue or something like that. So I think what you saw is a lot of venture investors chasing. A lot of venture firms were formed, a lot of capital was formed, and we're kind of seeing the washout of that now, right? Where rates are coming back up. In Hong Kong, I was talking to people, family offices who are saying, yeah, we're not deploying to venture anymore because on the private debt side, we're getting 20% interest collateralized, right? Like, why would I ever go into ventures now? So that is a true risk that needs to be worked through. But you also have to remember that venture, unlike the public markets, is not transacted on day by day. It's not even year by year. It's almost decade by decade, which means a lot of these problems that a lot of people know are in front of the venture capital ecosystem, like overcapitalization, too high valuations, no liquidity for a lot of these companies, no exits. This is going to play out over a 10-year period, right? It's not like the public markets where hedge funds can correct and come in and prices move down in a day. This takes a decade to do, right? So I think we're starting to see the beginnings of that with large institutions, number one, pulling back their commitments to a lot of these funds. They're asking to see DPI to the earlier funds before they commit to the new ones. You brought up a lot of dry powder in the industry. There is a lot of dry powder in the form of committed capital, but that capital needs to be called. And to call that capital today, some LPs may push back, right? So that might not even be real capital that's ready to deploy. So we're seeing a lot of different firms take a lot of different approaches to try to solve this problem. GPs are in a tough spot. Companies that aren't the tier one grades are in a tough spot. Fundraisers are in a tough spot. But I think this will play out over a 10-year period, if you ask me.
When here in Asia, one of the big topics, and I was talking to some auditors, we have a dialogue pretty much on a regular basis. And the observation in the last 2 years is because of both the pandemic and sort of destabilization in some of the global supply chains, this bled up into very challenging valuation issues where not only did you have a backlog, but there was still a gap between mark to market between how the managers and the GPs felt about the assets and how some of the LPs were perhaps even contesting. Where are we on that now? Has that gap closed, or are we still fleshing those numbers out?
Yeah, in the private equity markets, those gaps close over time, but a little quicker than they do in venture. Typically, PE funds mark their assets mark to market all the time. And, that happens over quarters and whatnot. And you can argue things might be a little bit overvalued, but in general, you have somebody who has to decide what the valuation is every time. In venture, it's a little bit different. Auditors are a little bit more laxed on how venture GPs mark their assets. So most of them mark it to the last priced round, which an argument is fair, right? It's the last price where everybody took a look and decided what the price was and new capital came into the business. And venture managers don't own the companies. So they're not in a position to dictate exactly what the company should be worth. All venture investors, whether you're a tier one or tier five, you're a minority shareholder of the company. Maybe you have one board seat out of 7. So that makes sense that you hold it to the last price round that a larger investor did, and you kind of wait. And the argument from a lot of GPs is, well, why do I even need to remarket? Because my LPs have signed up for a 10-year horizon. We're 5 years in. The marks don't mean anything, right? Because you're not
trading. There's no liquidity event anyway.
Exactly. If you're not trading these securities, which you're not supposed to be as a venture investor, then why do the marks even matter? So I completely stand on the side of venture GPs who don't want to mark their books. I think that's perfectly fine. I think a lot of people in my space feel like it's fraudulent or they should be remarking it. And I just think, what's the incentive? What's the reason? There's no reason why you'd need to. On the venture side, we are starting to see some GPs mark down their books, right? Some of the GPs who are more in tune with the markets maybe have a little bit more risk out there. They tend to mark things down a little bit each quarter, right, to reflect the current environments. Some GPs have decided to mark things based off of where the secondary platforms, and the exchanges have shares trading relative to the bid-ask spreads. But I think in large part, most GPs are still holding things at last round. Kind of makes things a little bit challenging on, for example, secondary firms. When you come in and want to provide liquidity solutions, well, then you're taking a discount to what might be a stale mark. But it's sort of all over the place today.
When we look at, and you kind of hinted at it, I'm imagining that a lot of these deals are protracted, and it's not because of the funds or the LPs or the GPs. It's not their business, as you mentioned. This is really a result of, a couple of things. One is just, it might not be the right time for the issuer to list or find a liquidity event, or they may be forced to pivot from an IPO, for example, to a private sale or an industry sale and purchase. And that usually take somewhat of a hit on the valuation. But assuming that you're in the game or you're one of the first subscribers, still be making decent capital if things work the way they're supposed to. So how does this affect liquidity or expectations, I guess, of LPs who came in on day one?
I think at the end of the day, the IPO markets is the bread and butter of liquidity in venture capital. Okay, full stop. I think there's a lot of people selling private equity and M&A, but that just doesn't happen. If you look back, I think over the last 7 years, if you add it together, The Mag 7 has only made less than like $8 or $9 billion acquisitions. It just doesn't happen. And then if you think about the companies out there who can support $1 billion acquisition, there's not a lot of them. So M&A at the strategic level doesn't happen for big companies. The small end, there's a lot of tuck-ins and whatnot, but that's not really counted as a success in venture capital. I think the other leg of liquidity is the private equity markets, right? And a lot of private equity managers are looking at the 2,000 unicorns that are venture backed and there's no exit window for them. So it's a great time for them to come in and buy. And in theory, I think that is true. And we're going to start seeing that in the margins. I think the challenge with that is what I said, the last decade of low interest rates and capital flowing into these companies. A lot of these companies have raised too much capital relative to where their fundamentals are today. So even as private equity buyers come in and lob bids, they're not going to get accepted because maybe 5 times revenue doesn't even cover the preference stack for a lot of these founders. So why would I sell to a private equity firm and get zero? I'd rather take my chances with 6 months cash left and try to make something of it and rather see the company go to zero than exit to private equity. So I think, in fact, over the next 5 years, we're going to see a lot of companies who could have sold to private equity actually choose the standalone route and go to zero rather than exit, which is quite unfortunate. And then the IPO markets. When markets are good, the IPO markets are open. When they're bad, they close. In an average, probably about 30 to 50 tech companies that IPO every year. It doesn't sound like a lot, but there's only 50 trading weeks in a year, right? So that's one a week. Even in the best of times, like if you look at 2007 or 2020, pre-COVID, post-COVID, you get about 100 to 150 tech IPOs a year. And again, there's only 250 trading days in a year, so that's like one every other day. So literally, Wall Street is capacity constrained in their ability to bring IPOs. You're not going to see 300 IPOs a year. That's just not going to happen. So you're limited by, call it 50 a year. There's $2,000 billion backed unicorns in venture that want IPO. It's not going to happen, right? It's not going to happen. So a lot of these companies are going to stay private for a while. I think the next trend that Wall Street is pushing is, okay, the private IPO, right? We're hearing a lot about that. Oh, these companies are choosing to stay private because the public markets, there's too many hurdles, there's too many regulations, and there's abundant capital in the private markets. These CEOs don't want to go public. And I think we see a lot of venture GPs argue that. If you ask me, it's a bit of a scapegoat excuse to explain to their investors why their companies aren't exiting, right? To blame it on regulation.
Oh, wait, but what does that mean? Private IPO. So what's the mechanism behind a private IPO? Because the way you're describing it is they simply don't list at all. But to say it's a private IPO means that there's some type of liquidity event that's happening.
Yeah. Wall Street has coined the term the private IPO now, and it's basically a secondary round for these late stage companies, where it's company-led tender and, a large Wall Street firm can come in and help execute that tender. So it does give the early employees and founders and investors a way to sell to larger secondary or venture firms that want to buy into the company. So it's just the primary, secondary offering of the company in the private markets. They're calling it a private IPO. So we are seeing some of that, but all that does really is extend the timeline to exit. And when we talk to founders and CEOs and GPs, what we really find is these companies actually want to go IPO. None of them actually want to stay private. And the challenge today is the valuation mismatch between the public markets and the private markets, where there's still so much money in late stage venture where you can invest in these high tech companies and push the valuations really high, whereas the public market comps for those same companies are trading at half the valuations. So if company XYZ is going to go IPO today, it might have to trade at a 50% discount to the last round that was just 2 months ago that a venture investor invested in. So a lot of companies need to outgrow that problem, but at the same time, they're waiting for the environment to get better where you can raise an IPO valuation. You still add a step up to your last round. You don't want to be coming out at a discount. So in fact, what I see is a macro issue and a valuation issue across the two asset classes, and not an issue of regulation holding these companies back or they're choosing to stay private for whatever reason.
So this brings us to kind of what you were doing at Industry Ventures, right? Which is helping LPs and helping the market find liquidity on a pre-IPO basis. Can you walk us through how that mechanism works?
Yeah, there's a lot of different mechanisms to provide liquidity. for venture-backed companies. And I want to describe PE first because VC secondaries really emerged out of PE secondaries. If you think about any private equity-backed company that you want to get exposure to, well, traditionally, they don't offer shares to their employees and their founders aren't shelling. So the only way you can get exposure to it is through the GPs who want to restructure their funds or the LPs in those funds. So let's say you want to get exposure to company XYZ. There really is only one GP in one fund that bought the company and maybe 100 or 200 LPs in that fund. And that's all you can do to get it. Venture is a lot different. It's a different animal. If you look at a company like Stripe, okay, not only do you have 2,000 employees in Stripe that all get shares, you also have about 2,000 former employees that also still have shares, right? So that alone, there's about 4,000 or 5,000 people you can go after to exposure. The cap table of a company like Stripe has about 200 to 300 line items on there. Venture firms, endowments, sovereign wealth funds, accelerators, angels, you name it. And of the 200 line items on there, 100 of them are venture firms. And venture firms each in their funds have about 100 to 150 LPs. So if you think about it in its totality, if you want to get exposure to a company like Stripe, there's probably 100,000 to 500,000 different avenues where you can try to get that exposure. And that really creates a lot of opportunities and inefficiencies as to where these assets price. You may ask an employee, hey, where do you want to sell your shares to sell it at this price? The founder may do a different price. The GP may do a different price, and the LP in the fund may do a completely different price. So what we saw industry and what we see at NeuCo today is we want to access these best-in-class top-tier companies, and we want to be able to have the toolkit to go across any mechanism we want so that when we see an asset that we want at the lowest price relative to all the other avenues, we can strike that one. And that requires a little bit of understanding around, okay, how do you transact on an LP interest? Okay, how do you transact on a corporate carve out of assets? Okay, how do you transact on forward contracts or direct shares or company-led tenders? And having that knowledge across the secondary base really helps rather than just, oh, we're just going after founders. We're just going after employees or LPs because you really pigeon yourself that way.
I want to step back a bit because it's one thing to go after employees and sort of like day one employees, where theoretically, if we could, as an investor, if I could acquire those shares, I would therefore replace them on the cap table, right? Or at least that's the intention. And one of the most frequent questions that I get from family offices here is, okay, this looks like an interesting deal, but can you get me on the cap table? So what's the reasoning behind that? I get the sense that, of course, they do want to have those ownership rights, shareholder rights, et cetera. But in any one situation, especially in the case of Stripe, for example, unless you amass a very large lot size, your voting rights anyway are going to be somewhat inconsequential. What's the motivation there and the difference then behind what you're doing today, which is like acquiring secondaries from LP interests?
There is a real legitimate concern why some investors want to be on the cap table, and primarily comes down to one factor, which is exitability. So when the company goes IPO, if you're a small holder of common shares, you typically are not subject to a lockup period and you can choose when you want to exit, right? So that's really the only reason why. Otherwise, if you buy common shares, even if you buy Series C or preferred shares and you're a secondaries investor, you're not going to get line of sight to management. You're not going to be on the board of directors. You're not going to get information rights. Your share ownership really is just going to sit there and collect dust. So the approach that we like to do, and I like to do at NeuCo, is go through the funds. So you can get exposure to the company through employees selling their shares, and you can get on the cap table where the only benefit is you can choose your exit. Or we can go through the funds where, one, we might be able to access the companies at meaningfully deeper discounts than the direct side. That's sort of the offset to not being able to choose your time horizon exactly, is that, hey, you may be able to get them 40-50% cheaper, right? So is that downside buffer worth it to you? But for us, we see a lot of value in going through the interests and the funds because most of the GPs of these funds sit on the board of directors, right? So they can share with you that information if you have a relationship. Most of these funds report updates on their companies, not just in the company you want, but other companies in their portfolios. You get invited to the AGMs and then you get to see the quarterly letters. So you also get that network effect benefit of going through these funds which we find to be very helpful in terms of building a longer term sustainable advantage in secondaries. Not to go on, but a lot of secondary firms we see today are going the direct route because it's simple and it's what they understand. And they'll go out and acquire companies, shares in companies that they know and like and think are undervalued. The problem with that is that your information arbitrage, there is no information arbitrage. After a few years, you don't sit on the board of directors of these companies. You're not in the network. So what good does that exposure do you when you're raising fund 3 and people are asking, hey, where's your edge? Where's your informational advantage? You don't really have any. Whereas building that base of being in the funds, having the relationship with the GPs 5, 6 years down the road, you have amassed a lot of informational advantage across these companies and funds that you can leverage when you're deploying in the future.
You touched on a point in earlier, which is kind of like a liquidity discount, where potentially because you may not have as flexible, you can't time your exit as clearly as you would if you were a direct holder, then that warrants liquidity discount in a way. Those are big numbers, like 50%, 50 cents to the dollar, et cetera. Does it change as well depending on the lot size? Like there's the liquidity discount itself going from direct holder to LP holder. And then is there another discount from large LP holder to a smaller LP holder?
Yeah, yes, there is. There's a liquidity discount embedded in these things. And I think that gets maximized a little bit in venture secondaries specifically, where you're facing a lack of buyers and a major supply of sellers, right? So that illiquidity discount is not simply just an illiquidity discount. It's a market-driven illiquidity discount that maximizes it a little bit. We do see that illiquidity discount across deal sizes too on the LP side. And in fact, it's a little bit opposite than what you would expect or what you're used to in the public side. In the public markets, if you want to sell one share of Google, the bid-ask spread is really tight and you can transact just like that. If you want to sell a $500 million block, okay, then you got to go through a trading desk and you're going to have to chop it up and take a slight discount and whatnot. In venture secondaries, we're seeing the exact opposite take place, which is not right. Whereas if you have a large interest in a fund, call it $50, $60 million, there's a lot of secondary players who are large and sophisticated who will pick that up. And I won't name any names, but they're the large predominant secondary funds. Whereas if you go to the same fund and find an LP that's only $2 million or $5 million, there's actually no liquidity at that space. And the illiquidity premium expands, right? Because the firms that know how to do these things are managing tens of billions of dollars. They're not going to waste their time on a $2 million deal. But if you look across that landscape, there's nobody there who understands how to transact on it. So in fact, in private equity, we say when you go smaller, you're going after SMB, you're going after mid-market, different quality of assets. In venture secondaries, especially on the fund side of secondaries, when you go smaller, you're going after the same asset with the same fee structure, managed by the same GP with the same asset exposures, just a smaller check size, and the illiquidity premium expands a lot. And what's interesting about that smaller market is that 90% of venture LPs in the venture market is owned by small investors who write $100K to $1 million checks. Unlike PE, where you're writing big checks, most of venture is small checks. So if they're in a fund that's 10 years old and they've been marked up, chances are their value sitting today at about between $1 to $5 million. So there's the vast market of venture is in this small segment that's really being underserved by what we see.
Wow. So is this what NeuCo is doing? NeuCo is, are you targeting sort of like the smaller lot size? And then, am I right to say you're targeting small lot sizes, aggregating them into a larger, so you're going from like the $2 million, $5 million deals, aggregating them potentially to a $50 million deal? And then I guess the natural question, the elephant in the room for me is, how do you exit? Like, how do you then generate liquidity if they couldn't find liquidity at their stage?
Yeah, so for us, our strategy is to go after those smaller lot sizes. LP interests, GP-led situations, special situations where somebody's looking for liquidity on a block that's $10 million or less, that's in many ways undercovered by these larger players. They may be doing the same exact deal and same exact assets, but $50 million, we can do the same one for less and probably actually get a better price as well. So in that sense, yes, we're going after the smaller size. In terms of bundling them together, that's not really our priority. Of course, we're raising a certain fund size, and the idea will be to diversify across a lot of managers and a lot of good assets. But that's just our high-level deployment strategy. In terms of getting exits, you have to remember a lot of the LPs that are selling, It's not that they couldn't get liquidity. They committed to a fund that's invested in assets, and those assets haven't gone IPO or exited yet. And in many cases, a lot of LPs might not even know what's in their portfolios. If you take a pension, for example, that's winding down an old legacy vehicle that houses 100 LP interests, there's a lot of tail LP interests in there that are less than $5 million allocated to venture funds. And when they're offloading it, they're not really paying attention to what's inside. So there could be high quality assets that we, through our diligence, have identified, okay, is on a path to IPO or is on a path to M&A or liquidity, and we can take advantage of that. So for us, our number one priority in access in generating liquidity through our fund is to invest in the right assets, invest in assets that are on a track to IPO, the highest quality companies. But because of the seller dynamics, where maybe they need to buy their daughter a house, maybe they're going through, unfortunately, bankruptcy proceedings or divorce or just winding down a vehicle, or they've just been in the fund for 10 years and I just want some money back. Right? Simple as that. We can take advantage of that situation and capture some great assets at some deep discounts.
When you look at these portfolios, do you have the option of cherry picking the LP interest? You don't, right? You have to take it in whole. So if the LP has a broad or concentrated exposure, you kind of have to take the whole portfolio as one. So I would imagine that's quite a bit of work because you then have to look at not just the main assets that you might be targeting, but also the ancillary assets and also run a valuation as well. So it's kind of like those auctions. I have a friend who all she does is she goes to wine auctions and she buys entire collections at a time. And so the fun part for her is going to the individual bottles and roughly estimating which of the bottles on average together might be worth more than the worthless bottles as a portfolio. Is this kind of what you're doing, right?
That is a very good analogy. I think the only difference between what she does and what we do is that companies change over time. Wine bottles don't change over time. So for us, yeah, on day one, it might be a collection of 20 companies that are each just one bottle sitting there. But as these companies progress, some of them will go under, some of them will get acquired, and some of them will raise subsequent up rounds. I'll give you an example of a deal we just did for an LP of ours, where we helped them purchase an LP interest in a fund that's a 2011 vintage.
Wow.
And that fund invested in a company called Xiaohongshu at the Series A.
Oh my goodness.
But because they got him at the Series A, yeah, Xiaohongshu is now almost 90% of the fund.
Wow. They just raised they're recently valued at 17 billion. That is
$17 billion valuation.
Yeah.
Yeah, on the secondary markets by company tender, I think in 2022, a while ago. And they're currently trading in the secondary markets at about 30 to 35.
Wow, my goodness. I guess this is because of what happened in the last 6 months, right? When it was TikTok, when they temporarily shut down TikTok, all of the users had jumped over to Little Red Book, Xiaohongshu, and that boosted up their numbers quite significantly.
Yeah, definitely. And the company fundamentally is doing really well too, right? It's profitable, it's growing, the metrics look really good. And I think the consensus is that it's one of the ones that if the Asian assets can IPO, it's definitely one of the ones that will be first out of the gate. And with that portfolio we helped buy for that LP, it was 90% Xiaohongshu. So yes, we're going in and buying a portfolio, but if we do it right and we're buying these early vintage portfolios, they should be highly concentrated across 1, 2, maybe 3 core assets, right? That make up bulk of the majority. And then the rest of the tail, we can underwrite it our own way. Right? So we're really focused on the asset qualities inside. We're not really buying portfolios. We're buying assets via portfolio model, if that makes sense.
Right, that makes sense. So that's to suggest that in most of these LP cases, they should be concentrated books rather than like a broad basket.
Yeah, I think if you look at any like 2015 vintage fund, for example, and if you invested in a company that did really well, chances are that company is the majority of your portfolio today, right? If you had a 2015 vintage fund and it's still very diversified, that means nothing went right. So those aren't portfolios that we target. We also don't target early fund portfolios where there's not a clear winner, you can't clearly underwrite them and you're taking venture risk. And we're trying to minimize that venture risk. We're going after the highest quality companies that we know are, over 500 million revenue, growing, profitable, on a track to IPO. And they're highly concentrated in these funds where, yes, even though we're buying a fund position, our core exposure is just 1 or 2 assets that we want.
On the Xiaohongshu case, on a side note, the word on the street is that it's going to be tough for them to list on NASDAQ. So how does that play into your strategy? I mean, how do you look at how this might turn out, not just for Xiaohongshu, but for other companies here in Asia, especially in China, who are doing really well, but because of political reasons might not list in NASDAQ? Is Hong Kong still a destination for them?
Definitely. It's definitely still a destination. London is a possible destination. All right. I think it all depends. It's like going to a grocery store. Right? You can go to the most popular grocery store, but there are always secondary ones out there. Obviously, it'd be best to list in the US, but if that's not possible, I think we're going to see a lot of dual listings going forward in Asia and potentially Europe. As to the timeline for Xiaohongshu's IPO and the mechanics around that, not too privy on that, right? But if you look at these companies fundamentally, it's very clear that it's not a question of if they're going to exit. It's a question of simply when. And when the moment presents itself, that's when the market will open. Unfortunately, for a lot of ventures investors who've been in for 10, 20 years, they don't have the luxury of waiting any longer.
Yeah, I hear what you're saying. I mean, from the sound of it, and maybe you can paint the picture for me, because when we first started the chat, there's something in the neighborhood of 2,000 some odd unicorns, right? A lot of them are doing very, very well as well. But then to your point, you can only, and the market can only absorb so much liquidity as we start IPOing these to market. So I'm putting myself in your position, picking those not only have fundamental strength, but also closest to IPO would be my main priority. So I guess the question is, how do you get that sense of who's closest to the front of the line?
Yeah, and that comes down to how we do our diligence. It's a little secret edge of how we do that, right, in terms of exitability. But I would say that I think that's one of the biggest pieces that a lot of secondary investors miss. A lot of secondaries investors are still coming at secondaries from a primary lens, which is let's investigate the company, let's analyze the fundamentals and figure out a good price to get into. That's great if you're a primary investor and your LPs are giving you a 10-year time horizon. But as a secondaries investor, where LPs want you to kind of generate distributions quickly, I'm not worried about you getting the next big winner. I just want you to generate that distribution really fast. Well, then half your time really should be spent on diligencing the exitability of these companies and how likely is it to go IPO? Because fast forward 5 years from now, even if I got a portfolio of great assets at great prices and they're all doing really well, well, it doesn't really matter from a secondaries perspective because you haven't generated any distributions. So I like to say good secondaries investor isn't preoccupied with the quality of the assets that they're investing in, right? We'll invest in the best asset in the sector. We'll invest in the worst asset in the sector. As long as there's a path to exit and you can price it, that's what a secondary investor should be focused on.
Right. Something one of my more successful uncles reminded me, more often than not, liquidity trumps price. And this seems to be one of the drivers, especially for the strategy.
Yes.
When you look at sectors right now, I guess maybe let's take a step back. Is there a trend for, I mean, obviously the elephant in the room on this is like AI, for example, and a ton of capital kind of flooded into AI and into the space. Now we're seeing a pullback because of the deep sea effect, et cetera. When you look at where we are now thematically, what kind of companies do you feel are most ripe for liquidity and for IPO?
Look, the AI narrative is hot, and we're seeing a lot of companies kind of hit $100 million in revenue faster than you could have ever expected, right? Being enabled by AI. So I think there will be a new breed of companies coming to market. I think you also have to remember that you can't use the traditional metrics to value those companies as well, right? Because as fast as you can grow that revenue, well, you can get disrupted just as quickly as well. So investors are going to take a different sort of metric to thinking about those companies. In terms of the liquidity of what's going to be the first companies out, I don't think any of the AI names are going to be the first ones out. The first ones out are going to reflect the situation in the public markets. So what you want is you see where public sentiment is relative to the public markets, and it's low, right? It's low. You have quality above all, and nobody cares if it's AI or what, they're quality above all. And then you want to give a step higher of something just a little better. So the first companies out, if you ask me, are going to be companies that you don't imagine. If you think about the companies that just IPO'd over the past few months, Hinge Health, like it's not an AI name. Why Hinge Health? So we're going to see the companies that are between 500 to 700 million ARR, growing 20 to 30%, cash flow positive. Yeah, AI not a big deal, but something fundamental that's compounding and growing and that people can get behind in the public markets. Those are going to be the first companies out, if you ask me. The AI names, in fact, it's going to take many years because it's going to take a lot of years to build out and prove out those business models and the fragility or resilience of those business models. And the valuations for those are a little bit too high at the moment, right? You're going to have to see some proof points first. And those B grade companies, I wouldn't say B grade, A minus grade, right? Ones you don't think of coming out first. There's also a way to test the markets. These companies are testing the markets. Wall Street's testing the markets to see, okay, is this IPO holding? Okay, if this is holding, let's bring out something even higher on the risk curve. Okay, if that one's holding, bring out something even higher on the risk curve. So before any of the hottest names can go public, you have to see some of these medium kind of grade companies go public first to make sure that the market is stable and ripe and supportive. Okay, then the big ones will come out.
I need to bring this back to Asia in a way. Are you seeing any interesting deals out here in Asia that you personally would love to get your hands on?
In periods of risk off, capital moves to security and areas of liquidity, right? And that's why we've seen capitals flow out of Southeast Asia and China. And it just goes to safe havens. And Asia today, unfortunately, is not the largest safe haven in the world. So while there are great opportunities we're seeing, especially on the secondary markets, where because of these tensions between the US and China, a lot of US investors are offloading their Asian assets almost for any price because they just want to get out. You can see it in the public markets too. Alibaba trades at like 5 times EBITDA, right? What that reflects is nobody wants to buy. And that's the same in the private markets. And you can imagine with the illiquidity premiums, how much deeper those prices even get. So we are seeing a lot of sellers offload, get out of Asia for any reason they can, at any price they can. So there's a lot of great opportunities out there in terms of price. But then again, that comes back to the liquidity situation, which is, okay, you're investing in these companies, but what's the liquidity outlook going to look like for Asia? And there, I don't have a clear picture for it. I think for investors in Asia that are smart, understand the landscape, understand the companies, there's a lot of great deals to be had right now in the secondary space.
But what we're saying here, Jonathan, is that we're staying in our lane. We're sticking to the large deals, US-centric, or at least US listing, and go from there. Okay, great.
Yeah, for us, the focus is on US. That's where we have the relationships. That's where we know these companies and can get information. But, I think many of our LPs are going to come from Asia. And a lot of them are looking at these very discounted Southeast Asian and Chinese LP interests, where we sort of bring our expertise and help them underwrite and execute a little bit. And they bring the macro knowledge and the company knowledge of it and say, yeah, that's a good price, and we work together that way.